Warren Buffett and Charlie Munger are renowned for their succinct, powerful insights on investing. One of their most famous quotes has guided countless investors. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This advice is often celebrated as timeless wisdom, offering a clear path to long-term success. Yet, beneath its surface lies a subtle risk that many overlook. While the quote appears straightforward, it can also become an intellectual trap, leading investors astray if interpreted too narrowly. In this section, we will uncover the hidden danger embedded within this celebrated guidance, challenging conventional assumptions and revealing what every investor should know. Is it truly wise to assume that simply holding onto investments will always yield positive results over time? What if market conditions change in ways that erode value despite our patience? Could the buy and hold philosophy overlook critical shifts in industries, technologies, or global economies that fundamentally alter the landscape? For long-term investors, the stakes are high. Relying solely on this strategy may expose portfolios to risks that gradual market growth cannot offset. Are we ignoring warning signs by clinging to tradition? And what consequences might that have for our financial futures? This video unfolds through three interconnected layers of investigation. At the core lies the main trap, a pattern that often ensnares our judgment when evaluating companies. Nested within this are two key words whose subtle burden shapes our perceptions and decisions. The third loop explores a widespread misinterpretation that frequently distorts our understanding of what makes a company truly wonderful. As you follow along, consider your own experiences with organizations you've regarded as exceptional. How might these loops have influenced your perspective? As we move forward, the focus shifts from general observations to a deeper investigation. This phase marks a turning point where we begin to scrutinize widely accepted investing advice. By examining common strategies and beliefs, we aim to uncover the strengths and potential pitfalls that often go unnoticed. Prepare to engage with a more critical perspective as we analyze the foundations of popular financial guidance. This approach will help reveal which recommendations truly stand up to scrutiny and which may require a more cautious evaluation. The idea that simply buying stocks of companies you recognize and holding them forever guarantees investment success is a popular myth. This approach often leads investors to make decisions based solely on brand familiarity rather than careful research or analysis of a company's financial health and market position. While it may feel reassuring to invest in household names, this strategy overlooks the importance of adapting to changing market conditions and evaluating whether a company's prospects remain strong over time. Blindly holding on to stocks without reassessment can expose investors to unnecessary risks, especially if a once prominent brand faces decline. Ultimately, relying on passive investing rooted in familiarity can result in missed opportunities and potential losses, highlighting the need for a more thoughtful and informed approach. Many investors believe that simply holding shares in popular companies will eventually lead to profits. However, history tells a different story. For example, Cisco Systems was one of the most sought-after stocks during the dot-com boom, yet investors who bought at its peak in 2000 waited more than a decade just to break even. Similarly, General Electric, once considered a blue-chip staple, saw its stock price decline for years, erasing significant shareholder value. These cases highlight that even well-known companies can experience prolonged periods of stagnation or losses. The passage of time alone does not guarantee investment success. Careful analysis and adaptability remain essential. The myth of effortless wealth often turns the discipline of investing into a passive exercise in wishful thinking. Instead of carefully researching and selecting investments, many fall into the trap of buying popular stocks at inflated prices, hoping that time alone will erase their mistakes. This approach can result in a buy and regret portfolio, where disappointment replaces the promise of growth. Overpaying for trending stocks rarely leads to long-term success, as market enthusiasm can quickly fade. Relying solely on time to recover from poor choices overlooks the importance of valuation and sound strategy. Ultimately, this mindset exposes investors to unnecessary risk and missed opportunities for genuine financial progress. It's important to recognize that this quote does not offer a simple or passive solution. Instead, it presents a philosophy that demands careful thought and active engagement. While its message may seem straightforward at first glance, the true challenge lies in its subtle complexities. Embracing this approach requires ongoing effort and a willingness to confront uncomfortable truths. Beneath its surface, the philosophy calls for resilience, adaptability, and a deep understanding of oneself. The difficulty is not in hearing the words, but in living by them. Loop 2 begins by uncovering the deeper meaning behind the quote. The advice offered is not simply a casual suggestion, but rather the result of a hard-won realization. Before arriving at this guidance, two formidable challenges had to be overcome. The first was the task of truly understanding what wonderful means in this context, which is often more elusive than it appears. The second hurdle involved enduring a long time, a test of patience and resilience that can feel nearly insurmountable. Together, these experiences shape the wisdom found in the quote, highlighting the significance of both discovery and perseverance. Defining a wonderful business requires careful analysis of several key factors. One of the most important is the presence of an economic moat, which refers to a company's ability to maintain competitive advantages that protect its profits from rivals. High returns on capital indicate that the business can efficiently generate earnings from its investments, setting it apart from average performers. Prudent management plays a crucial role, as leaders who allocate resources wisely and make sound strategic decisions help sustain long-term growth. Finally, even the best business can be a poor investment if purchased at too high a price. So it's essential to buy shares at a reasonable valuation. Together, these elements form the foundation for identifying truly exceptional companies. True understanding goes far beyond simply recognizing a familiar brand name. It demands a thorough and thoughtful analysis of a company's fundamentals, strategies, and market position. Most investors, however, are either unwilling or unable to commit to this level of rigorous research. Instead, they often rely on surface-level impressions or popular sentiment, which can lead to misguided decisions. Genuine insight is earned through careful study and critical evaluation, not through shortcuts or assumptions. This distinction separates those who truly grasp the nature of an investment from those who merely follow trends. Holding an investment through prolonged market downturns presents a significant psychological challenge. As prices fall and uncertainty rises, fear and doubt can easily overshadow rational decision-making. Many investors feel compelled to sell, hoping to avoid further losses, but this reaction often leads to missed opportunities when markets eventually recover. Conviction, rooted in thorough analysis and a deep understanding of the investment's fundamentals, becomes crucial during these turbulent periods. It provides the confidence needed to stay the course, even when headlines and emotions suggest otherwise. By relying on well-founded research rather than short-term market movements, investors are better equipped to withstand volatility and make decisions that align with their long-term goals. The ability to hold an investment for an extended period is not simply a default approach, but rather a privilege that must be earned through careful and rigorous analysis. Contrary to the popular myth that passive holding guarantees success, the reality is that it demands ongoing diligence and informed decision-making. Investors who commit to holding long-term have typically scrutinized every aspect of their investment, ensuring it aligns with their goals and risk tolerance. This active engagement distinguishes successful holders from those who rely solely on hope or market trends. In closing, true long-term holding is the result of continuous evaluation and discipline, not passive indifference. Throughout our investigation, we have collected several key pieces of evidence. Each clue has pointed toward a subtle pattern hidden within the famous quote, revealing layers of meaning that are not immediately apparent. By analyzing the language, context, and historical background, we have uncovered connections that suggest the quote may contain a cleverly disguised trap. The recurring themes and nuanced phrasing have led us to reconsider our initial assumptions. As we prepare to address the original question, these findings will help us understand how the trap operates and why it has remained unnoticed by so many. The stage is now set to reveal the true nature of the hidden trap embedded within the quote. Here lies the real revelation. The popular quote subtly nudges investors toward a passive mindset, encouraging them to simply hold on without questioning deeper fundamentals. This approach can be misleading as it diverts attention from the crucial tasks of analyzing a company's financial health and understanding the price being paid. By focusing solely on holding, investors may overlook warning signs or miss better opportunities. The quote, while comforting, becomes an intellectual shortcut, one that can lead to complacency. Recognizing this trap is essential for making informed decisions and avoiding the pitfalls of blind optimism. History offers clear examples of how long-term holding can falter when investments are made at excessive valuations. In 1989, the Japanese stock market reached unprecedented heights, with the Nikkei index peaking near 39,000 points. Investors who bought at these levels faced decades of stagnation, as the market struggled to recover its former value. Similarly, Cisco Systems became a symbol of the dot-com boom in 2000, trading at sky-high prices. Despite the company's continued growth, shareholders who purchased at the peak waited over 15 years just to break even. These cases highlight a crucial lesson. The price you pay is the anchor for your future returns. No matter how promising the asset, overpaying can severely limit long-term performance. When investors misinterpret popular financial quotes, they often fall into the trap of equating hope with a sound investment strategy. This confusion can lead them to rely on wishful thinking rather than thorough analysis and planning. Additionally, many assume that investing in well-known brand names automatically guarantees safety, overlooking the importance of evaluating fundamentals and market conditions. As a result, long-term investors may become complacent, failing to adapt to changing circumstances or reassess their portfolios. This tendency to rely on reputation and optimism, rather than disciplined research and risk management, contributes to widespread underperformance among long-term investors. Ultimately, success in investing requires more than faith in familiar names or hopeful expectations. It demands a clear strategy and ongoing vigilance. For the prudent investor, genuine safety and peace of mind are not simply the result of holding assets and hoping for the best. Instead, they stem from a commitment to thorough analysis, careful and disciplined purchasing decisions, and the patience to wait after diligent effort. This approach requires active engagement and a willingness to dig deep into the fundamentals before investing. By prioritizing these principles, investors can navigate uncertainty with greater confidence and clarity. True ease in investing is earned through preparation and persistence, rather than relying on passive strategies alone. In value investing, safety means protecting your capital by thoroughly analyzing investments and choosing those with a margin of safety. This is achieved not by relying on reassuring slogans, but through diligent research and disciplined decision-making. Peace of mind comes from having confidence in your investment process, knowing that your choices are grounded in sound principles and careful evaluation. Ease in this context refers to the clarity and simplicity that result from a well-defined strategy, making it easier to navigate market fluctuations. Each of these core values is realized through active effort, conviction, and a commitment to rational analysis, rather than passive hope or catchy phrases. By consistently applying these principles, investors build a foundation that supports long-term success and resilience. Building lasting wealth begins with patience and dedication. By consistently putting in the effort and waiting for the right opportunities, you earn the privilege to own exceptional businesses. The only dependable path to secure, peaceful wealth is through hard work, disciplined saving, and careful investment at sensible prices. Rather than seeking shortcuts or quick gains, focus on steady progress and sound decision-making. Over time, this approach not only brings financial security, but also peace of mind, knowing your success is built on a solid foundation. As we wrap up, consider taking a moment to like, share, and subscribe to stay connected with future insights. We invite you to comment below with your own personal investing rules, as your experiences can help others learn and grow. If you have a favorite quote you'd like us to analyze in an upcoming episode, feel free to suggest it in the comments. Your engagement helps shape the direction of our investigations. Thank you for joining us today and being part of this thoughtful exploration.